You're watching Magnetic Media News Network. I'm Mia Kudos. This is Behind the Headlines. Because what matters isn't only what happened, it's what happens next. Let's begin. What happened? Global bond yields have surged to multi-year highs in recent sessions, driven by clear signals from major central banks that interest rates will remain elevated for longer than previously anticipated. The shift follows a series of communications from policymakers emphasizing concerns about persistent inflationary pressures. Markets had earlier priced in rate cuts within the year, but these expectations have now been pushed back significantly. The move has been most pronounced in longer-dated bonds, where yields have climbed sharply, reflecting revised growth and inflation outlooks. Who does it affect? This shift in bond yields directly impacts governments, corporations, and households reliant on borrowing. For governments, higher yields mean increased debt servicing costs, which could strain fiscal budgets and limit spending on public services or infrastructure. Corporations, particularly those with high levels of debt, may face higher refinancing costs, squeezing profit margins and potentially delaying expansion plans. Households will feel the effect through higher mortgage rates, reducing disposable income and cooling housing market activity. Investors holding fixed income assets may see capital losses, while those seeking safer assets could face lower returns in a higher rate environment. Ultimately, this repricing of risk could dampen economic activity and alter consumer behavior. What should we watch next? First, keep a close eye on central bank communications, particularly any hints about the timing or conditions for future rate adjustments. Policymakers' language will be critical in shaping market expectations and could either stabilize or further unsettle bond markets. Second, monitor inflation data releases, as any signs of stubbornness or acceleration could reinforce the higher-for-longer narrative, while softer readings might prompt a reassessment. Third, watch corporate earnings reports for mentions of refinancing challenges or shifts in capital expenditure plans, as these could signal broader economic impacts. Finally, observe currency markets, where higher bond yields could attract capital flows, strengthening currencies like the dollar and creating headwinds for export-driven economies. Smart money, reducing exposure. Smart money is taking a cautious stance in response to the surge in bond yields, reducing exposure to interest rate-sensitive assets. That is what sits behind today's headlines. Thank you for joining us for Behind the Headlines. Until next time, stay informed, stay ahead. And if you haven't already, subscribe for more intelligent analysis, Monday to Friday.